Demystifying foreign exchange risk, what every business needs to know. Foreign exchange risk can be a significant challenge for businesses operating internationally. In this video, we will demystify foreign exchange risk and provide you with the essential information every business needs to know to navigate this complex landscape. Understanding foreign exchange risk. Foreign exchange risk, also known as currency risk, is the risk that fluctuations in exchange rates will negatively impact the value of a business's international investments, transactions, or operations. These fluctuations can significantly affect a company's profitability and financial stability. Types of foreign exchange risk. There are three main types of foreign exchange risk that businesses should be aware of. Transaction risk. Transaction risk is the risk that arises from the effect of exchange rate movements on transactions denominated in foreign currencies. This risk can impact the cost of goods, services, or payments made in a foreign currency. Translation risk. Translation risk, also known as accounting risk, is the risk that changes in exchange rates will impact the value of a company's financial statements when they are translated into the reporting currency. This can affect the company's balance sheet and income statement. Economic risk. Economic risk, also known as operating risk, is the risk that exchange rate fluctuations will affect a company's future cash flows, investments, or competitive position in international markets. This risk is more long-term and strategic in nature. Managing foreign exchange risk. Managing foreign exchange risk is essential for businesses looking to minimize their exposure to currency fluctuations. Here are some strategies that businesses can employ. Hedging. Hedging involves using financial instruments such as forward contracts, options, or futures to protect against exchange rate fluctuations. By hedging, businesses can lock in exchange rates and reduce the impact of currency risk on their operations. Diversification. Diversification involves spreading international operations across multiple countries with different currencies. By diversifying operations, businesses can reduce their exposure to currency risk in any single market. Netting. Netting involves offsetting payables in one currency with receivables in another currency. This can help businesses reduce the overall impact of exchange rate fluctuations on their cash flows. Conclusion. Foreign exchange risk is a complex but manageable challenge for businesses operating in the global marketplace. By understanding the types of foreign exchange risk, businesses can implement effective strategies to manage and mitigate their exposure to currency fluctuations. Remember, proactive risk management is key to protecting your business's financial performance and stability in an increasingly interconnected world.
The basics of foreign exchange risk and its impact on your business. Foreign exchange risk can seriously impact your business if not managed properly. In this video, we'll delve into the basics of foreign exchange risk and explore its implications on your business operations. What is foreign exchange risk? Foreign exchange risk, also known as currency risk, is the risk that changes in foreign exchange rates will adversely affect the value of a business's investments or operations. It arises when a company engages in international trade or has foreign currency-denominated transactions. Types of foreign exchange risk. Transaction risk. Transaction risk is the risk that arises from fluctuations in exchange rates between the time a transaction is entered into and when it is settled. It impacts businesses involved in importing or exporting goods and services. Translation risk. Translation risk, also known as accounting risk, is the risk that changes in exchange rates will negatively impact the value of a company's financial statements when they are translated into the home currency. Economic risk. Economic risk, also known as operating risk, is the risk that long-term cash flows of a company will be affected by changes in exchange rates. This risk impacts businesses with foreign investments or operations. Impact of foreign exchange risk on your business. Profitability. Unmanaged foreign exchange risk can lead to significant losses for your business. Fluctuations in exchange rates can directly impact your profitability, especially if you have international transactions. Cash flow. Changes in exchange rates can disrupt your cash flow projections. If your cash flows are denominated in a foreign currency, fluctuations can impact your ability to meet financial obligations or invest in crucial areas of your business. Competitive position. Unanticipated changes in exchange rates can affect your competitive position in the market. If your competitors manage foreign exchange risk better than you do, they may have a cost advantage that could affect your market share. Managing foreign exchange risk. Hedging. Hedging involves using financial instruments, such as forward contracts, options, or currency swaps to mitigate the impact of exchange rate fluctuations on your business. This strategy allows you to lock in exchange rates for future transactions. Diversification. Diversifying your revenue streams across different currencies can help reduce your exposure to foreign exchange risk. By operating in multiple markets, you can offset losses in one currency against gains in another. Continuous monitoring. Stay informed about geopolitical events, economic indicators, and changes in exchange rates that could impact your business. Regularly review your risk management strategies to ensure they align with your business goals. Conclusion. Foreign exchange risk is a crucial consideration for businesses engaging in international trade or investments. By understanding the types of foreign exchange risk, its impact on your business, and implementing effective risk management strategies, you can safeguard your business against potential losses and seize opportunities in the global marketplace. Remember, managing foreign exchange risk is essential for the long-term success and sustainability of your business.
Effective hedging strategies for managing foreign exchange risk. Foreign exchange risk is a major concern for businesses engaged in global trade. Fluctuations in currency exchange rates can have a significant impact on a company's financial performance. To mitigate this risk, companies can implement effective hedging strategies. In this video, we will discuss some key hedging techniques that businesses can use to manage their foreign exchange risk. Forward contracts. One commonly used hedging strategy is the forward contract. With a forward contract, a company agrees to buy or sell a specific amount of currency at a predetermined exchange rate on a future date. By locking in the exchange rate in advance, companies can protect themselves against unfavorable currency movements. Options. Another popular hedging tool is options. Options give the holder the right, but not the obligation, to buy or sell a currency at a specified exchange rate within a set period. Companies can use options to hedge against downside risk while still benefiting from favorable exchange rate movements. Currency swaps. Currency swaps involve the exchange of principal and interest payments in different currencies. This allows companies to effectively hedge their foreign exchange exposure without having to actually exchange the underlying currencies. Currency swaps are often used to hedge long-term exposure to foreign currency fluctuations. Money market hedging. Money market hedging involves borrowing or lending in different currencies to offset foreign exchange risk. By matching the currency of their assets and liabilities, companies can reduce their exposure to currency fluctuations. This strategy is particularly useful for managing short-term foreign exchange risk. Natural hedging. Natural hedging involves structuring business operations in a way that naturally offsets foreign exchange risk. For example, a company that generates revenue in a foreign currency while incurring expenses in the same currency is naturally hedged against exchange rate fluctuations. Companies can also use invoicing in local currency as a form of natural hedging. Risk netting. Risk netting involves offsetting exposures in different currencies to reduce overall risk. By consolidating inflows and outflows in different currencies, companies can minimize the impact of exchange rate fluctuations on their bottom line. In conclusion, managing foreign exchange risk is crucial for businesses engaged in international trade. By implementing effective hedging strategies such as forward contracts, options, currency swaps, money market hedging, natural hedging, and risk netting, companies can protect themselves against currency volatility and ensure financial stability in the global marketplace. How to use currency forwards to protect your international transactions. If you're involved in international business, you know that currency exchange rates can significantly impact your profits. One way to minimize this risk is by using currency forwards. In this video, we will explore how currency forwards work and how you can use them to protect your international transactions. What are currency forwards? Currency forwards are a financial contract that allows you to lock in an exchange rate for a future date. Let's say you're a US-based company that needs to pay a supplier in Japan in 3 months. You can enter into a currency forward agreement with a financial institution to buy Japanese yen at a fixed exchange rate on the payment date. How do currency forwards work? When you enter into a currency forward contract, you agree to buy or sell a specific amount of currency at a predetermined exchange rate on a future date. This means you can protect yourself from unfavorable exchange rate movements. If the exchange rate moves against you, your company won't lose money because you've already locked in a rate. However, if the exchange rate moves in your favor, you won't benefit either because you're committed to the agreed upon rate. Benefits of using currency forwards. Using currency forwards can provide your business with stability and predictability in your international transactions. It helps you mitigate the risk of currency fluctuations and protect your profit margins. By knowing the exact amount you'll pay or receive in your local currency, you can better manage your cash flow. Currency forwards also eliminate the uncertainty associated with fluctuating exchange rates, allowing you to focus on your core business activities. How to use currency forwards. Assess your risk, identify your exposure to foreign exchange risk by analyzing your international transactions. Consult with a financial advisor, seek guidance from a financial advisor or currency expert to understand the benefits and risks of using currency forwards. Enter into a forward contract. Once you've identified your currency exposure and consulted with an expert, you can enter into a currency forward contract with a financial institution. Monitor exchange rate movements. Keep an eye on exchange rate movements leading up to the contract's maturity date. Evaluate your strategy. Regularly review your currency hedging strategy to ensure it aligns with your business goals and risk tolerance. By incorporating currency forwards into your risk management strategy, you can protect your international transactions from volatile exchange rate fluctuations and safeguard your bottom line. Identifying your currency risks, a step-by-step guide. Currency risks can have a significant impact on businesses that operate internationally. In this video, we will walk you through a step-by-step guide on how to identify and manage currency risks effectively. Understand your exposure. The first step in managing currency risks is to identify your exposure. Determine which currencies your business deals with and the potential impact of exchange rate fluctuations on your financials. Quantify your risks. Next, quantify the risks associated with each currency. Calculate how much your business stands to gain or lose due to currency fluctuations. This will help you prioritize which risks to focus on. Analyze external factors. Consider external factors that may impact currency movements, such as economic indicators, political events, and market sentiment. Stay informed about global developments to anticipate potential currency risks. Conduct scenario analysis. Perform scenario analysis to understand how different exchange rate movements could affect your business. Simulate various scenarios to assess the best and worst case outcomes and prepare accordingly. Utilize hedging strategies. Explore hedging strategies to mitigate currency risks. Options like forward contracts, currency swaps, and options can help protect your business from adverse exchange rate fluctuations. Monitor and review regularly. Continuously monitor your currency exposure and review your hedging strategies. Currency markets are dynamic, so it's essential to stay proactive in managing your risks. Seek professional advice. If managing currency risk seems daunting, consider seeking advice from financial experts or consultants specializing in foreign exchange. They can provide valuable insights and recommendations tailored to your business needs. By following these steps, you can identify, assess, and manage currency risks effectively, safeguarding your business against unexpected exchange rate fluctuations. How to conduct a comprehensive foreign currency risk assessment. Doing business internationally comes with some risks, especially when dealing with foreign currencies. To avoid unexpected financial losses, it's crucial to conduct a comprehensive foreign currency risk assessment. In this video, we'll guide you through the process step by step. Identify exposure. The first step is to identify all potential sources of foreign currency risk exposure in your business. This includes foreign currency transactions, investments, and operations. Evaluate how these exposures could impact your financial performance. Analyze risk factors. Next, analyze the specific risk factors associated with foreign currency exposure. Consider economic conditions, exchange rate fluctuations, political stability, and market volatility in the countries where you operate. Quantify risks. Quantify the potential impact of foreign currency risks on your business. Use financial modeling techniques to simulate different scenarios and assess the financial implications of adverse exchange rate movements. Develop risk management strategies. Based on your risk assessment, develop appropriate risk management strategies to mitigate foreign currency exposure. These may include natural hedging, financial hedging instruments, diversification, or operational strategies. Implement hedging instruments. If financial hedging is part of your risk management strategy, consider using derivatives such as forward contracts, options, or swaps to hedge against currency fluctuations. Consult with a financial advisor or risk management specialist to choose the most suitable hedging instruments. Monitor and review. Regularly monitor your foreign currency risk exposure and review the effectiveness of your risk management strategies. Adjust your hedging techniques as needed based on changes in market conditions or business operations. Educate employees. Educate your employees about foreign currency risks and the importance of risk management. Ensure that key personnel are aware of the strategies in place and how they can contribute to mitigating risks in their respective roles. By following these steps and conducting a comprehensive foreign currency risk assessment, you can proactively manage risks and protect your business from the uncertainties of the global currency markets. Exploring financial instruments for foreign exchange risk management. Managing foreign exchange risk is crucial for businesses operating in the global market. Fluctuations in exchange rates can have a significant impact on a company's bottom line. In this video, we will explore various financial instruments that businesses can use to mitigate foreign exchange risk. Forward contracts. Forward contracts are one of the most common tools used for managing foreign exchange risk. They allow businesses to lock in a specific exchange rate for a future transaction. This helps companies hedge against potential currency fluctuations and provide certainty in terms of cash flows. Options. Options give businesses the right, but not the obligation, to exchange currencies at a predetermined rate on a future date. They provide flexibility as they allow companies to benefit from favorable exchange rate movements while limiting potential losses if rates move unfavorably. Currency swaps. Currency swaps involve the exchange of principal and interest payments in different currencies. This financial instrument helps businesses manage their foreign exchange exposure by allowing them to convert one currency into another at an agreed-upon exchange rate. Currency futures. Currency futures are standardized contracts traded on exchanges that obligate the parties involved to buy or sell a specific amount of a currency at a predetermined price at a future date. Businesses can use currency futures to hedge against currency risk and speculate on future exchange rate movements. Cross-currency hedging. Cross-currency hedging involves using a combination of different financial instruments to manage foreign exchange risk. Businesses can create a hedging strategy that best fits their specific needs by using a mix of options, forwards, and other instruments to protect against currency fluctuations. Money market hedge. A money market hedge involves borrowing or lending in a foreign currency to offset the risk of exchange rate fluctuations. By matching the currency of assets and liabilities, businesses can protect themselves from currency risk without using derivative instruments. Risk management policies. It is essential for businesses to establish clear risk management policies regarding foreign exchange exposure. These policies should outline the company's risk tolerance, hedging strategies, and procedures for monitoring and evaluating currency risk. In conclusion, managing foreign exchange risk is critical for businesses operating in the global market. By utilizing a combination of financial instruments and implementing sound risk management policies, companies can effectively mitigate the impact of currency fluctuations on their operations. How derivatives can be used to hedge against currency risk. Currency risk is a major concern for businesses engaged in international trade. Fluctuations in exchange rates can have a significant impact on a company's bottom line. One way to manage this risk is by using derivatives. In this video, we'll explore how derivatives can be used to hedge against currency risk. Understanding currency risk. Before we dive into how derivatives can help mitigate currency risk, let's first understand what currency risk is. Currency risk, also known as foreign exchange risk, is the risk that an investment's value will decrease due to changes in the value of the currency of the investment's underlying assets. For example, let's say a US company is selling products to customers in Europe. If the euro weakens against the US dollar, the US company will receive fewer dollars when converting their euro-denominated sales back into dollars. This can result in lower profits for the US company due to currency fluctuations. Using forward contracts. One common derivative used to hedge against currency risk is a forward contract. A forward contract is an agreement between two parties to exchange a specified amount of one currency for another currency at a future date and at a pre-agreed exchange rate. For our US company selling products in Europe, they could enter into a forward contract to sell their euros at a fixed exchange rate, thereby protecting themselves from the risk of the euro depreciating against the dollar. Options for hedging. Another commonly used derivative for hedging currency risk is options. Currency options give the holder the right, but not the obligation, to buy or sell a currency at a specified exchange rate before a specified expiration date. For our example, the US company could purchase a currency put option, which gives them the right to sell euros at a specified exchange rate. If the euro weakens against the dollar, the company can exercise the put option and sell their euros at the agreed-upon exchange rate, thereby limiting their losses. Using currency swaps. Currency swaps are another derivative instrument that can be used to hedge against currency risk. In a currency swap, two parties exchange currencies for a specific period of time and then re-exchange them at a later date. For our US company, they could enter into a currency swap with a European company to exchange their euro-denominated sales for dollars at a fixed exchange rate. This would eliminate the risk of currency fluctuations between the two currencies. Conclusion. In conclusion, derivatives can be powerful tools for managing currency risk in international trade. By using instruments such as forward contracts, options, and currency swaps, businesses can protect themselves from the adverse effects of exchange rate fluctuations. It's important to note that while derivatives can help mitigate currency risk, they also come with their own set of risks and complexities. It's advisable for businesses to work with financial professionals to determine the most suitable hedging strategies for their specific needs. And that wraps up our overview of how derivatives can be used to hedge against currency risk.
Developing internal policies for managing foreign exchange risk. In the global economy, businesses need to be aware of foreign exchange risk and implement strategies to manage it effectively. Developing internal policies for managing foreign exchange risk is crucial to protect a company's financial health. Let's explore some key considerations in creating these policies. Risk assessment. The first step in developing internal policies for foreign exchange risk management is to conduct a comprehensive risk assessment. Identify the areas within your business that are exposed to foreign exchange risk, such as international transactions, overseas investments, or foreign currency borrowing. Assess the potential impact of currency fluctuations on your financial performance. Policy objectives. Clearly define the objectives of your foreign exchange risk management policies. Determine whether the primary goal is risk mitigation, profit maximization, or hedging against currency volatility. Align these objectives with the overall financial strategy of the company to ensure consistency and effectiveness. Risk tolerance. Establish a clear framework for risk tolerance levels within the organization. Define acceptable levels of exposure to foreign exchange risk based on factors such as the company's financial position, industry dynamics, and risk appetite. Set limits on currency exposure to prevent potential losses due to exchange rate fluctuations. Hedging strategies. Implement hedging strategies to mitigate foreign exchange risk. Hedging involves using financial instruments such as forward contracts, options, or currency swaps to protect against adverse currency movements. Develop a hedging policy that outlines the types of hedging instruments to be used and the conditions under which they should be applied. Monitoring and reporting. Create mechanisms for monitoring and reporting foreign exchange risk within the organization. Establish regular review processes to track currency exposures, assess hedging effectiveness, and evaluate compliance with internal policies. Implement reporting systems that provide timely and accurate information to key stakeholders. Training and awareness. Ensure that employees are well informed about foreign exchange risk and understand the importance of complying with internal policies. Provide training programs to educate staff on how currency fluctuations can impact the company's financial performance and the role of risk management in mitigating these risks. Compliance and governance. Establish clear guidelines for compliance with regulatory requirements related to foreign exchange risk management. Define roles and responsibilities within the organization for overseeing risk management activities and ensure that internal policies align with external regulations and best practices. Continuous improvement. Regularly review and update internal policies for managing foreign exchange risk to adapt to changing market conditions and business dynamics. Evaluate the effectiveness of existing strategies and make adjustments as needed to enhance risk management practices. In conclusion, developing internal policies for managing foreign exchange risk is essential for safeguarding a company's financial stability in the face of currency volatility. By following these key considerations and implementing robust risk management practices, businesses can protect themselves against adverse impacts from foreign exchange fluctuations. Best practices in setting up currency management procedures for your business. Currency management is vital for businesses that deal with international transactions. Having proper procedures in place ensures that your business can effectively manage and mitigate currency-related risks. In this video, we will discuss some best practices to set up currency management procedures for your business. Understand your exposure. Before setting up any currency management procedures, it is crucial to understand your exposure to currency risk. Evaluate the impact of currency fluctuations on your business by analyzing your international transactions, suppliers, and customers. This will help you determine the level of risk your business faces and the areas where currency management procedures are needed. Develop a currency risk management policy. Create a clear and comprehensive currency risk management policy that outlines your business's approach to managing currency risk. Define your risk tolerance, objectives, strategies, and the responsibilities of each team member involved in currency management. Having a well-defined policy ensures consistency in decision-making and execution. Use hedging instruments. Consider using hedging instruments such as forward contracts, options, and swaps to mitigate currency risk. These financial tools allow you to lock in exchange rates for future transactions, reducing the impact of currency fluctuations on your business. Work with a financial advisor or currency specialist to determine the most appropriate hedging strategies for your business. Monitor currency markets. Stay updated on currency market trends and news that may impact exchange rates. Regularly monitor key currencies relevant to your business and be aware of geopolitical events, economic indicators, and central bank policies that can influence currency movements. Understanding market dynamics can help you make informed decisions when managing currency risk. Implement internal controls. Establish robust internal controls to prevent fraud and errors in currency management processes. Segregate duties among employees involved in currency transactions, perform regular reconciliations, and conduct periodic audits to ensure compliance with currency management procedures. Implementing internal controls safeguards your business from potential risks and ensures transparency in currency transactions. Train your team. Provide training to your employees on currency management procedures, risk mitigation strategies, and the importance of compliance with the currency risk management policy. Equip your team with the knowledge and skills necessary to identify and address currency-related issues effectively. Regular training sessions help foster a culture of awareness and accountability within your organization. Review and adjust procedures. Regularly review the effectiveness of your currency management procedures and make adjustments as needed. Take into account changes in market conditions, business operations, and regulations that may impact your currency risk exposure. Continuously improving your procedures ensures that your business remains proactive in managing currency risk. Conclusion: setting up effective currency management procedures is essential for businesses operating in a global economy. By understanding your exposure, developing a risk management policy, using hedging instruments, monitoring currency markets, implementing internal controls, training your team, and reviewing procedures regularly, you can strengthen your business's ability to mitigate currency risk and optimize international transactions.
Leveraging technology to mitigate foreign exchange risk. In today's globalized economy, businesses of all sizes are exposed to foreign exchange risk. Fluctuations in currency values can impact profit margins and overall financial stability. One key strategy to mitigate foreign exchange risk is by leveraging technology. In this video, we'll explore how technology can help businesses effectively manage and mitigate foreign exchange risk. Automated currency hedging. Technology allows businesses to automate their currency hedging strategies. Automated platforms can monitor exchange rate movements in real time and execute hedging transactions when certain thresholds are met. This helps businesses lock in favorable exchange rates and protect against unfavorable currency movements. Predictive analytics. Using predictive analytics tools powered by technology, businesses can forecast future exchange rate movements with greater accuracy. By analyzing historical data, market trends, and geopolitical events, businesses can make more informed decisions regarding their foreign exchange exposure. Cloud-based treasury management systems. Cloud-based treasury management systems provide businesses with a centralized platform to manage all aspects of their treasury operations, including foreign exchange risk. These systems offer real-time visibility into cash flows, exposure data, and hedging strategies, allowing businesses to monitor and manage their foreign exchange risk more effectively. Payment automation. By automating payment processes through technology, businesses can reduce the manual effort involved in managing foreign currency transactions. Automated payment systems can help streamline cross-border payments, minimize errors, and reduce processing times, ultimately mitigating foreign exchange risk. Blockchain technology. Blockchain technology offers secure and transparent solutions for managing foreign exchange transactions. By utilizing blockchain-based platforms, businesses can reduce counterparty risk, enhance transaction security, and improve the efficiency of cross-border payments. In conclusion, leveraging technology is essential for businesses looking to mitigate foreign exchange risk in today's dynamic global marketplace. By adopting automated hedging strategies, utilizing predictive analytics, implementing cloud-based treasury management systems, automating payment processes, and harnessing blockchain technology, businesses can effectively manage their foreign exchange exposure and protect their bottom line. Remember, staying informed about the latest technological advancements in foreign exchange risk management is crucial for maintaining a competitive edge in today's interconnected world.
The role of software solutions in foreign currency risk management. Foreign currency risk can drastically impact businesses that engage in international trade or have foreign operations. To effectively manage this risk, companies can leverage software solutions tailored to foreign currency risk management. Automated currency risk identification. Software solutions analyze currency exposure across different business activities and transactions. By automating this process, companies can swiftly identify potential risks and take necessary actions to mitigate them. Real-time data analysis. Software solutions provide real-time updates on currency movements and market trends. This enables businesses to make informed decisions regarding foreign currency transactions and hedging strategies. Scenario modeling. Advanced software allows companies to create and analyze various scenarios to assess the impact of currency fluctuations on their financial performance. This helps in developing proactive risk management strategies. Integration with financial systems. Software solutions seamlessly integrate with existing financial systems, streamlining the process of monitoring currency risk exposures and implementing hedging strategies. Compliance and reporting. Comprehensive software solutions assist businesses in complying with regulatory requirements related to foreign currency risk management. They also generate detailed reports for internal analysis and external stakeholders. Customization and scalability. Many software solutions offer customization options to align with the specific needs and preferences of businesses. Additionally, these solutions are scalable, accommodating the growth and evolving requirements of organizations over time. Training and support. Most software providers offer training and ongoing support to help businesses effectively utilize the features of the software for optimal foreign currency risk management. In conclusion, software solutions play a crucial role in enhancing the efficiency and effectiveness of foreign currency risk management for businesses operating in a global market environment.
Essentials of monitoring foreign exchange risks. Foreign exchange risks can have a significant impact on businesses operating internationally. Monitoring these risks is essential to protect your bottom line. In this video, we will delve into the key essentials of monitoring foreign exchange risks. Understanding currency exposure. The first step in monitoring foreign exchange risks is understanding your currency exposure. Identify which currencies your business is exposed to and assess the potential impact of currency fluctuations on your financial performance. Types of currency risks. There are three main types of currency risks to be aware of. Transaction risk arises from fluctuations in exchange rates between the transaction date and settlement date. Translation risk affects the value of assets and liabilities denominated in foreign currencies when financial statements are translated back into the reporting currency. Economic risk relates to the impact of exchange rate changes on a company's cash flows and market value. Establish risk management policies. Developing comprehensive risk management policies is crucial. Determine the level of risk your business is willing to tolerate and implement hedging strategies to mitigate potential exposure to foreign exchange risks. Monitor exchange rate movements. Keep a close eye on exchange rate movements. Utilize financial news sources, market data platforms, and economic indicators to stay informed about factors influencing currency fluctuations. Regularly review and update risk management strategies. Currency markets are dynamic and ever-changing. Regularly review and update your risk management strategies to ensure they are aligned with your business objectives and market conditions. Utilize hedging instruments. Hedging instruments such as forward contracts, options, and swaps can be valuable tools in managing foreign exchange risks. Understand the benefits and limitations of each instrument and choose the most appropriate ones for your risk management needs. Work with experienced professionals. Seek advice from financial experts and currency specialists to optimize your risk management approach. Experienced professionals can provide valuable insights and help you navigate the complexities of foreign exchange markets. Importance of scenario analysis. Conduct scenario analysis to assess the impact of different exchange rate scenarios on your business. By simulating various scenarios, you can anticipate potential risks and devise strategies to mitigate their impact. Monitor regulatory changes. Stay informed about regulatory changes that may impact currency markets and foreign exchange practices. Compliance with relevant regulations is essential to avoid legal risks and ensure smooth operations. Monitoring foreign exchange risks is an ongoing process that requires vigilance, analysis, and proactive decision-making. By understanding the essentials of monitoring foreign exchange risks and implementing effective risk management strategies, you can safeguard your business against the uncertainties of currency fluctuations. How to create effective reporting systems for currency risk management. Currency risk is a major concern for businesses operating internationally. To effectively manage this risk, it's crucial to establish robust reporting systems. In this video, we'll delve into how you can create effective reporting systems for currency risk management. Understanding currency risk. Before diving into reporting systems, it's important to understand currency risk. Currency risk arises from fluctuations in exchange rates, impacting a company's financial performance. By managing currency risk effectively, businesses can protect their profits and enhance financial stability. Establish key risk indicators. The first step in creating an effective reporting system is to establish key risk indicators, CRIs. CRIs are specific metrics that help monitor and measure currency risk exposure. These could include metrics such as foreign exchange exposure, currency volatility, and impact on financial statements. Utilize automation tools. To streamline the reporting process, consider utilizing automation tools. Automated reporting systems can collect, analyze, and present currency risk data in a timely and accurate manner. This not only saves time but also ensures data integrity and reduces manual errors. Implement regular reporting cycles. Regular reporting cycles are essential for proactive currency risk management. Set up periodic reporting schedules, such as weekly or monthly, to monitor currency risk exposure and performance against established CRIs. Timely reporting enables quick decision-making and adjustments to risk management strategies. Customized reporting dashboards. Create customized reporting dashboards that provide a comprehensive view of currency risk metrics. These dashboards should be user-friendly, visually appealing, and interactive, allowing stakeholders to access real-time data and insights. Tailor the dashboards to the specific needs of different departments within the organization. Conduct variance analysis. Variance analysis is a critical component of reporting systems for currency risk management. Compare actual currency risk exposure and performance against predetermined thresholds and targets. Identify deviations and investigate the root causes to take corrective actions promptly. Integration with risk management framework. Integrate reporting systems with the overall risk management framework of the organization. Align currency risk reporting with other risk areas, such as market risk and operational risk, to ensure a holistic view of the risks facing the business. This integrated approach enhances decision-making and risk mitigation strategies. Continuous monitoring and evaluation. Effective reporting systems require continuous monitoring and evaluation. Regularly review the performance of the reporting systems, identify areas for improvement, and adapt to changing market conditions. Currency risk management is an ongoing process that demands agility and responsiveness. Conclusion. Creating effective reporting systems for currency risk management is essential for safeguarding business interests in the global market. By understanding currency risk, establishing key risk indicators, utilizing automation tools, and integrating reporting with the risk management framework, businesses can enhance their ability to manage currency risk effectively. In conclusion, proactive and insightful reporting systems play a crucial role in mitigating currency risk and ensuring financial stability in an increasingly volatile global economy.
Join the Global Banking Hub today and unlock an extensive library of Treasury video courses with new content added every month to keep you up to date on the latest industry standards and practices. Whether you're looking to deepen your understanding of interest rate risk management, liquidity coverage ratios, or Basel III compliance, our expert courses are designed to give you the skills and knowledge you need to excel. Each course comes with a practical certification opportunity, allowing you to demonstrate your expertise and advance your career with feedback from a senior Treasury professional. As a member, you'll also receive our weekly global banking update reports, packed with actionable insights on global banking trends, regulatory changes, and market movements, giving you the tools to apply the latest developments to your organization's strategic decisions. Finally, our in-depth how-to guides provide step-by-step solutions to complex Treasury challenges, from calculating liquidity ratios to managing non-maturity deposits. These practical guides ensure you're equipped to tackle the real-world issues that matter most to your role. Become a member today.